Good afternoon and welcome everyone to today's US markets update and bulls versus bears. Great to see so many on today's webcast. My name is Kelly Meng, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster, along with our portfolio managers Stephen Lyle, Chris Wallerman, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the question and answers tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I'll now turn the presentation over to Joe.
Thank you, Kelly. Today's title of the presentation is NA, and what that is referring to is that when companies provide guidance, they will provide typically a range. And a company with very predictable earnings like Procter & Gamble will have a narrow range, and companies with less predictable earnings like an auto company or Boeing currently would have a very wide range of expectations. And when there's an economic shock, what we've seen in 2008 is companies withdrawing guidance. And the withdrawal of guidance is a reflection of the uncertainty in the projected earnings and should result in a discount in the price to reflect the risk in the potential earnings. What should be happening is that each of these companies will have financial models which help them to put inputs in of their costs and sales prices of foreign exchange, etc. And if their inputs have a wider range, then their forecasted earnings should have a wider range output, but they should still be able to make some projections, although a very wide bell curve around the average estimate. But a lot of times you get companies withdrawing estimates, and I think that practice will stop. But it has not stopped with strategists. As we enter into the end of the year, we're starting to get estimates for the following year from Wall Street strategists, or the bulls and the bears on Wall Street, the major strategists, and we have a number of strategists saying that their estimate for next year is not available, and that should be a reflection of risk and represent a discount that the stock market should be trading at. However, we're not trading at a discount, we're trading at a pretty big premium because of the low interest rates are encouraging people to borrow money and buy equities. So NA refers to a lack of estimates for the S&P 500 closing price for the end of next year. So that's not flipping. So this month was the strongest month for the stock market in, I had the month, but in 10 years or something, 11% on the S&P 500 for the period. We go from the weekend closest to the end of the month because I write on the weekend closest to the end of the month, so it's not always the month precise. Earnings estimates for 2021 are up 1.1%. That pushes the price earnings ratio, the forecasted price earnings ratio for 21 up 10% to 21.3. To give you some perspective, at the top of the dot-com bubble, we did not have depressed earnings as we have now. Earnings are now 20% below where they were the prior year. We were at peak earnings cycle at that time, and we got to 25 times forecasted earnings. So if you take a 20% discount off of this because we're in trough earnings, then the PE would be below that 21 level. But Goldman Sachs, for example, is forecasting a recovery to at least last year's levels. The 10-year Treasury yield did increase in terms of basis points. The yield is up to 86 basis points, still very low, indicating that there is a better probability of a recovery next year, but there is no risk of inflation. The very low interest rates encourage, of course, the government to borrow money, and as the government borrows money to provide stimulus, hopefully more in January, or it provides an opportunity for corporations to borrow money to buy stocks. And that goes back to a report that we wrote quite a while ago called The Virtuous Cycle, where we talk about M&A being fueled by debt and that causing stock prices to continue to go up. One of the reasons we were bullish, very, very bullish about 2 years ago. But the low interest rates provide a good source of capital, a very very cheap source of capital for companies to leverage up and make acquisitions. And we've seen quite a big increase in the M&A activity, which has benefited Goldman Sachs, our investment there. Companies are still providing guidance, but less guidance. Strategists should not be making NA predictions. The strategists have a job. And if their predictions are a wider range, then let's see the wider range. Let's see what comes out of your financial models and see what the range in expectations is. Because if we can see that bell curve and we can see that range, then we can take an estimate of how much risk there is in the market or the variable outcomes. But they should not be making NA predictions. Maybe it's just a little bit too early for them, but last year at this time they were all out, and this year they're not. So that's indicating that you got a bunch of chickens running the strategy departments. Speaking of chickens, did anyone see the Just Eat announcement in Singapore today?
Just Eat.
Just Eat, yeah, announced that they've approved lab-produced chicken for sale in Singapore. So you can take those cells, grow your chicken in the lab, and you don't harm animals. But that was approved today in Singapore. Nobody, interesting of these strategists, when we go through the bulls and bears and what the arguments are, nobody's even talking about foreign earnings. And half of the S&P 500 earnings, it's a little bit less than that now, but about half of the earnings for the S&P 500 come from overseas. For example, if you look at McDonald's, they get about 2/3 of their earnings in the United States, about 1/3 overseas, but those overseas earnings are growing at a much higher rate, so they get a higher valuation on the foreign earnings than on the domestic earnings because of the higher growth rate. And so you'd say that McDonald's, which has about 10% of its assets here in Australia, should be very sensitive to foreign exchange. And there are some parts of the world that are not recovering as quickly as the United States. Of course, the Trump policy of staying open and keeping the economy open is going to keep that economy moving compared to other countries, such as where we've got new lockdowns in France and in Germany and in the UK, and we'll talk about Australia a little more later.